Big Business This Week. I'm JD Durkin here from the trading floor of the New York Stock Exchange. As always, following the biggest stories shaping the world of markets, money, and business. And this week, we want to take a look back at some of the biggest stories, not just from this quarter or trading cycle, but really the whole year. Macro headwinds, volatility, AI bubble concerns, geopolitical shocks, and much more. Bret Kenwell joins the show this week. Bret is U.S. investment and options analyst at eToro. Bret, thanks for being here. Great to have you today.
Yeah, thanks for having me on the pre-Thanksgiving show.
Yeah, and what a time of year. Obviously, we all give gratitude and thanks this time of year, and there's a lot investors have to be thankful for with regards to how the market has performed, at least up until Thanksgiving. We're up about 13%. What, from your view, have been among the biggest driving macro forces for the conversation this year?
I mean, I think two things on the bullish side really stand out. One being surprisingly strong earnings growth. I think we don't have to look much further even than just this last season, this last quarter of earnings to see how strong those were. S&P companies beat expectations by had 82% beat rate just about. It was in line with last quarter, but the highest number we've seen in several years. Earnings growth expectations going into the quarter were 7 to 8%. They came out at 15. So earnings have been very, very resilient. And then the other piece of the puzzle has been a resilient consumer, resilient economy. And I think that has some question marks around it as we haven't had much data lately these last, 4 to 6 weeks. And really going into that important holiday season, investors are worried about the consumer. But so far this year, through 3 quarters of the year anyhow, that consumer's been fairly resilient, and that has helped really push the economy forward and the markets higher.
Yeah, we know the markets have been very responsive, of course, to monetary policy from the Fed. Half of the Fed's dual mandate is a specific focus, of course, on pricing pressures and the state of inflation. And we usually get a handful of inflation prints month to month. Of course, some of those data points have been tough to come by as of late, given the government shutdown. How do you describe, how do you sort of give a scorecard to where inflation is as we head into the holiday season, and has it set the stage for 2026?
Yeah, inflation is not moving in the Fed's desired direction. I think the Fed is kind of in a tough spot in the sense of inflation has been very stubborn. It has been inching its way higher. Again, we have a lack of data lately, which makes this all the more difficult, particularly makes the Fed's job a lot more difficult. But inflation this year has been moving the wrong way. But at the same time, we also have weakness and we have some softness in the labor market. And as you mentioned, the Fed's dual mandate is really stable prices and maximum employment. So they're at a crossroads here where there's a risk that they tend to one over the other and inevitably hurt the other side of their mandate. So it is a tough balancing act as we move forward. And it is the inflation part of it is putting pressure on consumers. And that's making things difficult from an economic perspective. But that all being said, investors should remember, stocks are an asset class, and it's an asset class that actually does pretty well in mild inflationary environments. And we've seen that really pan out over these last few years.
Are you looking at the current crop of Fed officials? Obviously, there's one decision left in December. We'll have some rotation for the committee next year. But right now, you sort of have what have emerged sort of three cuts of FOMC officials. You got the cut crowd, the hold crowd, and maybe the middle, more cautious crowd. And then, of course, there's politics involved with the Fed, maybe much more so this year than we've seen in a while. How are you thinking about the makeup of the Fed? And, of course, how difficult it is for them to be data dependent when there's not at least as much data as they're used to getting?
Yeah, I think to your point, there's been a lot of political pressure on the Fed this year. I would say the committee's actually done a very good job of tuning that noise out and working more so on the data than they are from that outside pressure. That's going to be an interesting talking point as we get to 2026 and we are talking about a new Fed chairman and how that's going to play a role in how it intertwines with politics, it intertwines with the White House in terms of what kind of interest rate policy we get from the Fed. But as we kind of go into December, the Fed a couple months ago said they expect 3 rate cuts this year, that being September, October, and then the third one being in December. But at the last meeting, Chair Powell, I think he tried to kind of tamp down expectations a little bit. He mentioned it's not a foregone conclusion we're going to cut interest rates in December. And that's I can't really blame him from taking that approach. I mean, we haven't had our normal set of data to work with, and for a group that is data dependent, making their decisions on it, that's a tough spot to be. The market certainly is back to expecting a rate cut in a couple of weeks. So if the Fed continues to throw cold water on that, or if they, don't go through with that rate cut, that could be a short-term hurdle for the market to get through. But I think, large, my perspective on interest rates is that the Fed's already cut twice in the last couple months. They're likely to keep cutting in 2026. Whether we get that cut in December or not, the path to rates is lower, and that should be viewed as a positive.
So badly want to be a fly on the wall in the rooms when these Fed officials, or at least really know what Jerome Powell is thinking when you have a day like last Friday, because now we're in the open period, right? You're not in a lockup period. So Fed officials can go off, they can go do press conferences, they can speak at the Brookings Institute, they can go overseas and give talks, and the market's moving based on all of those individual comments. And man, oh man, John Williams from the New York Fed last Friday threw the possibility of a December rate cut right back on the table. The market reversed in positive territory. It has not gone down since. You and I are recording this interview the day before Thanksgiving. We were set up for another day of gains that arguably has been kind of re-kickstarted after last week's volatility because of what one Fed official says. So how do you approach policy knowing that it is a committee vote, but member to member can say very different things, and the market's closely paying attention to pretty much what all of them have to say?
Yeah, I mean, to be honest with you, I think it's just one component of uncertainty that's in the mix. Right now we're it's a sort of a tale of two tapes. I think when you look at just something like the S&P 500 index, it's down like 5 to 6%, or excuse me, it was down 5 to 6. We've since seen a rally over these last couple of days. To your point about Williams's comments, but we see a pretty routine correction so far, right? We get 3 corrections a year on average, about 5 to 6% in the index. But on the other end of the spectrum, we have a lot of industries that are down 20 or 30%. We have the quantum names have done terrible. Even when we look in the Mag 7, all but 2 of them are down double-digit percentages. So on the surface, on an index level, this pullback might not look like much, but on an individual stock basis or on an individual industry basis, there's been some disproportionate losses in this group. And I think that's really weighed on sentiment. But a big part of it is from the uncertainty we have in the market, the Fed being one of them. There's this idea from a month ago or 6 weeks ago that the Fed was going to cut in December. It wasn't a question. They just were. And now there's this idea of will they cut, won't they cut? And it's going alongside the legal ruling of tariffs. It's going alongside the impact of a record-long government shutdown, worries of an AI bubble, as you mentioned at the top of the show. There's all these different moving pieces, and I think that's created a bit of a risk-off sort of environment for markets over these last couple of weeks. Now, the question will be, do investors step into that and buy that dip in what is seasonally a strong period of time and with confidence that the Fed will cut rates next month? Or is that narrative going to change, and are we going to continue to see volatility once we get back to our normal 5-day trading weeks?
Brett, speaking of narratives and how quickly they can shift, I was stunned to see the whiplash over the durability of the AI trade narrative that we've watched unfold the last week, because part of that big, to your point, we averaged 5% pullbacks a year in the S&P. Arguably, the one that caused last week's 5% pullback were concerns over the AI trade, over valuations. We're hearing the B word bubble used a lot more. And then that seemed to really have been flipped on its head. And right now you've got this as sort of an offshoot of that, this newly emerging kind of proxy where the market's kind of deciding, well, it's sort of NVIDIA versus Alphabet on the AI trade, which has even though they have to do business with one another, now the market is saying, well, look how solid Gemini 3 is. It has far exceeded expectations. Alphabet's trading at all-time highs, but sort of at the expense of NVIDIA. How are you watching how quickly the narrative changes over the AI companies? Because last week from the New York Stock Exchange, I watched it flip in a matter of hours, and it seems like we're kind of going back and forth much more quickly than we used to.
Yeah, I think, I think there's a couple of interesting storylines that have come out of this AI component. The irony of this whole thing is that NVIDIA just reported what really was an incredible quarter, and the guidance that they gave was even better. Revenue was above expectations, margins were above expectations. To me, that tells me that not only is demand strong, but NVIDIA still has the pricing power that it needs to command sort of this leadership role within AI. And the news that's coming out of Alphabet, the reaction, the arc we've seen in Alphabet has just been incredible. You go back a couple of years ago, this stock was, supposedly going to get killed by ChatGPT, and search was going to die, and they were the laggards of all laggards. No one seemingly wanted to own this stock, and now everything is going their direction, from antitrust to Berkshire taking a position, to this recent news about Gemini 3's launch and the praise that it's getting, and now it's TPUs being a competitor to NVIDIA's GPUs. I don't view the situation as black and white. I don't look at Alphabet's the new winner and NVIDIA's the loser. NVIDIA is still the gold standard in the AI trade. It's still the gold standard when it comes to the technology that it puts out there from a hardware and software perspective. They are the leader in this space. And, as much as investors want to talk about a bubble forming in AI, it's very hard for me to look at this as a bubble that's about to burst when the leader trades at 25 to 26 times its next 12 months of earnings. A very reasonable valuation for a company that still has a lot of growth left in the tank. And there's room for more than one. It doesn't just have to be supplying all of these chips. You have AMD coming online. You have Google potentially having this avenue of hardware revenue. So I think there's room for multiple players in this space.
Before we wrap up the AI, there's a lot. I'm looking at NVIDIA's chart here. NVIDIA has already sold off about 15% off its recent highs, which was only October 29th. When we talk, we've been using the phrase Magnificent Seven here for a few years. I wonder, would you consider changing around the category at all? Is there any name you would add to the Mag 7 to make it the Elite 8? Are there any real big notable laggards? Should we consider maybe moving things around? I wonder if the narrative's changed enough where it's no longer just enough to look at the mega caps plus Tesla, et cetera. Is there sort of a new pack you see emerging as we head into the new year?
I think two thoughts, I guess, on that Mag 7 construction, the components within that group. The first one, it will be a quick answer. It would be, I think Broadcom would have to be mentioned in that group. We're talking about a name worth more than $1 trillion. It had a 10%, 11% one-day rally the other day. That market cap's knocking on the door of $2 trillion at this point. It's really cemented itself not only within the AI trade, but really the whole semiconductor space. That is a name that is so hard to ignore, and I think for whatever reason, it's sort of quietly overlooked. Maybe for the more exciting stocks like your AMD's move so much more, or NVIDIA sort of being that AI leadership name. I don't know if Broadcom just kind of gets overlooked for those perspectives, but you can't deny how well the name has done over the years and how big this company has become. So I think if it was going to go to a Mag 8, we have to put in Broadcom. But the other point being, we see this type of rotation within the Mag 7 I don't want to say all the time, but all the time. Alphabet earlier this year or a couple years ago, it was dismissed. And now it's almost a $4 trillion company, the third most valuable name in the world. Meta was recently at all-time highs. That name is quickly down 20%. We see this rotation where the narrative shifts to a certain name or a certain company, sort of it's lost its way. It doesn't have growth. It's not attractive anymore. And then it gets to a point where the valuation really is attractive. And then we hear after a couple quarters, hey, this business isn't dead. And the money flows back into these names. So we see this happen all the time, be it Tesla, Amazon. Amazon's been a laggard lately. So I expect that rotation to continue not only in 2026, but likely for the foreseeable future.
Broadcom trading at all-time highs, up 66% year to date, basically puts it on par with what we've seen out of Alphabet. Actually, kind of comparable story. That's a great point there. Let me ask you about the crypto market. I've been, and maybe some other people, trying to scratch my head as we've watched the broader crypto majors sell off the last couple of weeks of correlation. Is there any obvious correlation between how something like Bitcoin trades to any other part of the market, right? Because as we've had these unwinding sessions, the more defensive risk-off trade, where we've seen tech and discretionary pull back, it's not like we've seen Bitcoin perform as the hedge on the other side. We've seen Bitcoin come down alongside a lot of the big mega cap names. How are you positioned? Your thoughts on crypto into the end of the year, which is normally a very strong time of the calendar for Bitcoin and the other crypto giants.
Yeah, interestingly enough, from a seasonality perspective, the Q4 does tend to be the best quarter for Bitcoin, and October tends to be the best month, and we're really seeing sort of the opposite playing out this year for that. I think longer term, it's longer term. I think we still constructive on Bitcoin, if not just from the idea of two approaches: one, easing regulations, and the other being institutional demand. There's this blend between DeFi and TradFi, and we're seeing sort of those institutional investors or investors that have not had an opportunity to own Bitcoin being able to do so moving forward. Now, to your point of correlation, yes, I think there is some concern. When we look back, even just this year, Bitcoin topped out in January, about a month before the stock market did, and we saw, of course, a big correction at the end of the quarter and into early April. But even in those first couple days of April, we had like a 10% correction in the market just in 2 days. And Bitcoin was positive both those days. So it does tend to be a leading indicator. And that really goes back over years. Those are just two examples from this year. But to see this crypto space do so poorly over these last 6 weeks is in my mind for something like the NASDAQ or tech stocks in general that have a higher correlation to crypto and to Bitcoin specifically. Now, the question is that correlation breaking where Bitcoin is becoming sort of its own asset and trades in its own way because of some of those factors, like more institutional demand or more institutional involvement? I think that's a question we're going to have answered over the next couple weeks and over the next couple months.
Yeah, Bitcoin's all-time high Monday, October 6th, reached a high of 126,272. It has already sold off since that time 30%. And obviously that and many other stories we'll continue to watch for the rest of the quarter and into the next year. Bret, awesome conversation. Before we let you go, anything else that's really big on your radar that you think may shape the conversation into the new year that you think we should be paying a bit more attention to?
I think right now, the big concern from a lot of investors is the state of the consumer, the state of the economy. Are we seeing weaknesses develop there that could sort of lead to more weakness, sort of become the self-fulfilling prophecy of a major economic correction? And quite frankly, we don't have the data to either confirm that that's the case or realize that that's not the case. So really, it's going to be key over these next few weeks to get the data back from the government and start to decipher where we really are. That does pose a little bit of a risk here in the near term and could even show some weak Q4 numbers that become an issue in Q1. But I think when we look at the bigger picture, the catalysts for this bull market are still in place. The way I'm looking at the market is we are in more of a routine correction than a major turning point in the cycle. When we look out to next year, we see strong earnings growth. Every sector in the S&P is expected to post earnings growth next year. That's something we haven't seen since 2021, which was, of course, that major rebound year from COVID. If we exclude that, we haven't seen it since 2018. So really, that potential for diversification and more sector involvement in the market could play a big role in sort of balancing out the S&P. But we really need to see the consumer hold in there. They're responsible for 2/3 of U.S. GDP. If we lose the consumer, we are going to lose this economy, and that's something we don't want to see next year.
Bret Kenwell is a U.S. investment and options analyst at eToro. I wish I could do this conversation much longer. That's all the time we have, but we'll do it again soon. Best to you and your family for the Thanksgiving holiday. We'll chat with you again on the other side of the holiday. Bret, thank you as always.
Yeah, thank you.